Happy to invite Richard Kramer from ARETE Research to talk about the truth about the advertising.
This is a very sparse crowd for this time of the afternoon. I guess I'm competing against the sunshine. I'll have to speak very quietly because the mic's very close to my mouth, so I could wake up everyone. What I'll do broadly is give an introduction to my company, talk about what we usually do, and give you a sort of stepping back a view of how we see the digital ad market, which I think is hopefully going to touch on some issues that haven't been discussed at this conference enough. The sort of many elephants in the room out there. So about ARETE, I set the company up in 2000. Left one of the big investment banks as the leading #1 analyst. I had this crazy idea to do three things. One is to provide exclusively, not without generating a ton of publicity, really high quality research for investors. Do it without any conflicts of interest, so we wouldn't get paid to say nice things, and have a great team that would travel around the world and see 200 or 300 companies a month to understand what was really happening. And we do that globally. I was in China last week. I'm here this week. I'll be in the States for a couple weeks after that. We're the people who aren't what I call examining the bark on the tree, but we're trying to look at the forest. So we try to step back with all the sort of immediacy and social media marketing that goes on and understand what the wider trends are. The MO of the company is that we can tell the truth. That means we say a lot of nasty things about companies as well as nice things, but at least we can be honest and point out what's really going on. We're trying to vaccinate the industry, if you will, against what we call fake views. And fake views are when a company suggests that their technology is the greatest thing ever without having any validation of it, and then pays someone to suggest that that's the truth. So, I mean, I spend all my time dealing in the financial markets, watching the stock market, watching listed companies, and my one piece of advice for anybody doing that is to beware the cheerleaders. What do I mean by that? This is the trend of unprofitable IPOs that's happened over the past 20 years. What you can see is actually that's not entirely up to date. If I put it up to date, it would be spiking up to record levels. But we are back to the days of the dot-com boom. And you know, there's a brand of cigarettes in the UK called Death Cigarettes. They say if you want to kill yourself, fine, we'll help you do that and we'll make a profit as well. That's kind of what's happening in the financial markets right now. So I won't talk about bubbles bursting or not, but what you can clearly see is there are many companies coming to the market that have never made money and are likely never to make money. And that doesn't mean that they can't be good investments, but the likelihood is extremely low. Anybody know this woman? Mary Meeker, queen of the internet? Everybody see her Kleiner Perkins slide deck? She came up with this phrase that, oh, we look at our smartphones 150 times a day. Anybody hear that one? You've heard that one? Yeah, heard that? She made it up. No basis in fact whatsoever. It's a classic fake view. As a matter of fact, Mary Meeker's slide decks are full of things which are designed to support the VC investments that she's making at Kleiner Perkins. Much like when you see Andreessen Horowitz talk about software eating the world, you can be sure that their portfolio is stocked full of software investments. Indeed, her successor at Morgan Stanley said the iWatch, the Apple iWatch, would have $17.5 billion of sales in its first year, and I think 6 years on, cumulatively, it has not reached that level. I think the VC industry is another source of these fake views that you need to watch very carefully. They fan the flames. I regard most of the VCs as running what I consider a pimp prostitute business model. They're there to exploit vulnerable young companies that don't know better. And unfortunately, we've seen many times that's, again, gone up in flames. Right now, one of the reasons why this business model is being practiced is because there is roughly $500 billion of cash on tech company balance sheets, and it's almost politically impossible to use, which is why you haven't seen Apple, Google, or Facebook make any major acquisitions. This cash is literally burning a hole in their pocket. I know another word that you hear all the time in the financial markets is strong. Right? You hear all the company that had strong results. What does that mean? It means nothing. okay? Here's an example, Publicis. They talk about how the group is stronger. They're constantly the strength of their results. And then when you look at the results, it means that they were actually down year on year. They didn't grow at all. But that's okay, because strong is a legally undefinable word. It means nothing. Does it mean you can bench press 400 pounds? Does it mean you smell like Munster cheese? It means nothing. But companies constantly use that word to signal that they're doing well, whether or not they are. So, you know, in the case of Publicis, they think they're a great weightlifter just by dint of being in the advertising industry, making a number of acquisitions, and actually having no organic growth. Another great example of that, you can look at these IPOs. Snap. When Snap IPO'd, there were 26 banks promoting its stock in the syndicate. They all naturally had buys on the stock. The stock went from $17 to $26 right away. We had a sell rating on the stock with a $9 target, and the stock today is 10. Anybody who listened to those 26 banks would have lost money unless they were in at the deal and they sold immediately. So my point of caution here is to be very careful with these companies. Everybody know the company Roku in the States? If you read their filing, you would say that, well, they've incurred operating losses for all of their history, expect to incur operating losses in the future, and may never achieve or maintain profitability. Now, you could say that that's just, they have to say that, the lawyers are making them say that, but that, I think, is the reality of a lot of these companies that's not often brought out. You know, I think the Lumascape, everybody's seen this. This is responsible for more value destruction than any single infographic I've seen. It has encouraged a huge number of companies to dive into this ad tech space that really had no place being there, and it's created a huge amount of deliberate, I think quite deliberate, market confusion, mostly to bring Terry Kawaja and the Lumascape team, as well as a bunch of other investment bankers, deals. So when we look at the methodologies of Nielsen, of eMarketer, of IAB, we find that a lot of those big hockey stick growth curves are based on very flawed methodologies of counting how big the digital ad market is. I think you need to be very careful when you see these numbers about hyper growth, because in a relatively low growth global GDP environment, if something is growing 50%, something has to be declining 50%. So ask yourself, what is that? And that's always the other side of the trade we're looking for. Equally, you've got the Gartners, IDC, and Forresters. They're kind of like the investment banks. They are running a pay-for-play business model, where if you pay them money, they say nice things, pay them more money, they say nicer things. If any of you have ever wondered why Microsoft is always in the upper right-hand quadrant at Gartner, look in their filings and you'll see that Microsoft is a 10% customer of Gartner, their largest customer worldwide. Of course, they're going to say nice things. I think there's a lot of parallels between the stock market hype and the volatility and what you see in the digital ad market, and I'll touch on those now. So what I wanted to talk about really was digital empires in the ad market and how it's a rigged market. And I think everybody needs to just deal with this as a fact and not pretend it's not happening. What do we mean by digital empires? First of all, you know, empires control distribution. They might call them ecosystems, the economics. The first characteristic of empires is they have a lot of money. And I'll give you the data on just what the operating cash flow and profit pools of Facebook, Google, Apple, Microsoft, and Amazon were in the last year in a second. Second is they basically set and collect tolls. A few years ago, one of the leading digital games companies, King Digital, reported that they paid $650 million in platform support payments to Apple and Google to distribute their games, in the terms of the 30% take that they had to pay every time someone bought one of their games via the App Store. Third thing is they make the rules, and many of you would have seen in the last week that Google decided that in terms of GDPR consent, there's a limit to how many people can get consent. So it doesn't matter if you've got terrific consent from your partner, you may not make Google's list of 12. They make the law, and they've got many people to sign what we call the data donation agreement. How many of you ever clicked, okay, I got it, the data donation? You've agreed to donate your data in perpetuity to the empires. There's a lot of apps there that are clearly trying to sneakily collect data and counting on the fact that you're not going to read the end user license agreement. Fourth area, clearly they control what's seen, and I think the last point about video and the shift to video, these companies clearly want to control the video content, not just for brand safety reasons, but because they know it monetizes well. Fifth point is they dominate mind share, and really what we've seen, the controversy over Cambridge Analytica and Facebook has been the recognition that these companies are applying behavioral psychology at scale. That's really never happened before. And then finally, these companies are global. If you're Coke or McDonald's, you surely realize that, look, Taylor Swift has 100 million followers on Instagram. Okay? You can't get that kind of scale in any one country, in any one platform, other than with these large players. You have, Adele, 2 billion video views, or Despacito, 4 billion video views. This scale only comes on these platforms, and they're the ones who are investing right now on the tech infrastructure. Both Facebook and Google are doubling their capex this year to support that. These are the vampire squids of the web. They will figure out any way, shape, or form they can do to collect data, and they will hoard it to themselves. And I think what we're seeing in GDPR is their position about hoarding data gets stronger and stronger. Now, we can talk about walled gardens. These are the hard numbers that we deal with forecasting all the time. We break these numbers down. We try to get behind the fact the company's disclosure is terrible. They try not to tell us, the financial analysts, anything. But you can see that on the left-hand column here, it totals up to about $184 billion. By the way, don't bother taking any pictures of this. There's going to be way too many animations. You're not going to be able to follow it. So I'll put my email address up at the end, send you a copy of the presentation. You'll be otherwise just sort of snapping away and looking at your phone instead of trying to listen to what I say. So there's about $180 billion of operating cash flow. This, to me, is even more interesting. The incremental margin. In other words, the sales, the additional sales, the $13 billion that Facebook generated of extra sales in 2017 came in at a 68% incremental margin. That means they kept 2/3 of every dollar of extra sales that they made, which is phenomenal. We have never seen businesses like this at scale perform like this. And we see something similar in China. I mean, there's also a digital empire in China, which is very much closed off to the West, with $50 billion of sales and 30 to 40% growth. And like the digital empires of the West, in the East, they have a lot of cash. All of these companies face huge pressures, and they're very afraid of regulation, which is one of the reasons why they're not spending their cash. But I also think you need to recognize, and this is something I've talked with a bunch of Israeli ad tech companies, and I always said, come on, guys, you need to get together and get scale. This is the computing science and engineering faculty at MIT, Carnegie Mellon, Stanford, Oxford, Cambridge. You'll see they tend to have about 150 faculty members each in computer science and engineering. And you'll see Google has about 4,000 PhDs in computer science working for it right now, and 30,000 as a whole computer scientists. They have critical mass of critical mass. And what really bugs me is to see a lot of companies that have 50 or 60 or 100 in their engineering teams trying to solve the world's problems, instead of realizing they need to build up some sort of critical mass to get together to take on the fact of these empires. These companies, these 5 companies are going to spend $47 billion in R&D in 2018. So money is not an object for them. And if you're going to find the ways to undermine these empires, and they are very dysfunctional companies, they always leave gaps in what they do, you're going to have to find ways to get together and build that kind of critical mass. What is happening right now is that cash flow in the first column and the additional sales they're getting in the second column are fueling an arms race, and they're competing with one another. They're not paying much attention to all the people nipping at their heels. This is my own take in trying to explain to people how Google works and how they run what I consider a rigged market, or in the financial market sense would be a rigged market. So here's the structure of the financial markets, and you tend to have an exchange like the New York Stock Exchange. Let's imagine, as a thought experiment for a moment, that JP Morgan owned the New York Stock Exchange. Okay? They owned it. Then let's imagine that they were the market maker. They were the person who could offer you to bid and offer on stocks on that exchange. And also they're the broker. They're suggesting that you buy a stock, and they were doing that in their own shares. That's effectively Google, AdX, DoubleClick Bid Manager, and YouTube, search, maps, etc. The notion that Google can make a market in its own stock, that it can set the bid-offer spread, would never be allowed in the financial markets because it's clearly prone to massive amounts of manipulation. And as a sites owner, as one of the world's largest publishers, they have a seat at both sides of the table. They also obviously run the clearinghouse and settlement system in the form of Google Analytics, so they tell you when your trade settled and what price it's settled at. This level of control would absolutely be unacceptable in the financial markets. You know, DoubleClick being the sole broker of YouTube would be like JP Morgan saying if you wanted to buy JP Morgan stock, you had to buy it through JP Morgan at the price that JP Morgan told you it was trading at, irrespective of what it's showing on the exchange, which was owned by JP Morgan. So that is, when we talk about digital ad markets being rigged, this is what we mean. I just want everyone to understand that because it's very rarely presented like that. Certainly Google wouldn't want to present it like that. The regulators don't want to accept that because that means a whole bunch of hassle in trying to figure out a new code of antitrust law. But this is the world we see. Oh, and by the way, for all the publishers out there, keep quiet. Google pays $20 billion of TAC every year, traffic acquisition cost. And by paying that out, it ensures that the publishers adhere to a sort of omerta code of silence to make sure that they don't mouth off about it or complain about that because they're holding the purse strings that are so critical to the publishers. Alex, you missed all my stuff about China. Sorry, it came too late. And you know, when we look at Facebook, we think, you know, okay, so we're seeing the New York Times constantly talks about the frightful five. The FT, Reina Fuquars, has every other week she has something about Silicon Valley has too much power. Google taking over the classroom. That sounds awful, right? The rivals, the regulators, they're all after these companies. Margaret Verstager is after them. Rupert Murdoch despises Facebook and Google with a passion. The Guardian, the left and right, all hate these guys. And clearly the publishers are suffering even though they're getting a lot of their money funneled through Google. It's interesting to note that in the Cambridge Analytica scandal or discussion with Facebook, they were criticized in their API for passing along personal information about their users, and that's something that publishers do every day in RTB. Right? So it's there's a little bit of an irony here. But I looked at this whole Facebook testimony in front of Congress you know, as a sort of as a kabuki theater, there was a mask on, right? Zuckerberg was there, sort of very emotionless, you know, and sort of like the Senator Jones and Senator Smith sort of pointing at him. I mean, let's face it, Facebook and Google are some of the most successful export businesses the U.S. has developed in the past decade. What's more, under the new tax code, they will have, let's say, $30 billion of sales in Europe, and let's say that comes in at a 40% margin, that's $12 billion, and 15% tax. That means there's $2 billion of tax on European citizens that's being paid back into the US. Why would they want to ruin that? And third, there's a lot of US interest behind these companies. If the CIA had a really good CIO, they would have invented Facebook and Google. They're not that clever, so they counted on Silicon Valley to do it for them. Right? So let's not look at that and think that there's some terrible adversarial relationship between the regulators and the leading internet companies. That's not reality. The reality is that their interests are aligned on many levels, and that's why we ultimately think that real regulation isn't really going to change much. It's going to take a very long time to change the basis of antitrust law. GDPR, I'll talk about it in the next slide, but it is going to increase the value of these first-party data sets. Why? Because these companies are the largest publishers in the world, and if you read the newly revised e-privacy draft law, they can oblige you to hand over your data in consent for free services. Again, giving them the reason to be more powerful. And by the way, I'm sorry, Ariel, I think you need to change the name of the conference. Programmatic, it's not some robot apocalypse. It's like saying computer-based advertising. There's nothing, you know, it's just a mystique word that was invented by the Lumascape to float Tremor and Rubicon and Rocket Fuel and Yumi and all these companies in 2013, 2014 and hype them up. Those companies are all either bust or sold or gone. And, you know, programmatic is just a tool. It's just a method. It's nothing special, so we shouldn't really present it as such. It's not some complete apocalypse for the old way advertising was done. So my point here is regulation is not going to reset the digital ad and data markets. it will, unfortunately, force out a lot of the weaker players, and I think that's what we're hearing with respect to GDPR. So let's talk about GDPR in specifics. I know there's somebody that likes to go around talking about data is the new oil, right? You all heard that, data is the new oil? Well, I mean, I think if that's the case, we need renewables, right? We need some way to reconsent people, to get people to accept that some of what the industry has done has been creepy and has been on the wrong side of invasion of privacy, and to reset that. The EU mandates legitimate interest, informed consent, all these greater awareness of data usage is coming, and I think it's going to lead to a very large, it's leading right now to a one-off review of multiple arbitrage business models. The next step is going to be bringing users closer to control of their data. This is from the Information Commissioner in the EU. He published this a couple weeks ago. He said, accept and continue. Billions are clocking into digital sweat factories without realizing it. That's the regulator trying to raise public awareness about it. The reality is the opt-out rates are very low, and that for most individuals, it's going to be business as usual. And yes, the ad tech industry is sitting there saying, please, I need data. I need personal data, like vampires. If you look at the Princeton academic studies, you can see that Google is already well positioned for this because they're in about 97% of the million website survey that was done. Facebook is in about 40, and everybody else is a much smaller number. So this, again, is going to make them stronger. What's going to happen with GDPR? Two things in our view. Again, this is very politically incorrect to say. One is some companies are going to outgun the regulator. The Irish Data Protection Authority, where Google and Facebook are domiciled, has a budget of 12 million euros. Google has 97 billion euros of cash. Facebook has 42. If it comes to a gunfight between lawyers, I know who I'll back between Google, Facebook, and the Irish Data Protection Regulator. The second is some companies are going to break the law. They are just going to realize that complying with GDPR would be breaking their business model. So, like you've seen in the enterprise software space and many other places, people will just aggressively break the law or quietly break the law, and then if they get caught, they'll say, oh, well, we're moving towards compliance. Do you say, that's crazy, you can't do that? Well, look at every investment bank in the world. They've all been caught and fined billions of dollars, again and again and again. It's more profitable them to break the law, make money, and pay some of it back to the regulators than to change their business model. So you look at all the data magpie businesses out there, the Experians and the Axioms and the Oracle with all its different databases. For them they could either write off all those investments, or they could continue to break the law and hope they aren't the ones singled out to get caught. And also you see all of this whole IT world investing there. It's very simple why they're doing it. They're following the money. All of a sudden the CMO got budget over data or tech spend, and these guys, Oracle, SAP developed its own DSP. Great. IBM, Adobe, Accenture, they're all investing in this space because they realize that's where the money is going. They're your new competitors. So every digital business faces this GDPR issue. Some of them may just choose to completely ignore it. Last thing I'll talk about is fraud. I think the question for every Israeli ad tech company is how much fraud do you see? Are you ankle deep, knee deep, or are you just swimming in it? There's a lot of companies out there that are complicit in this. Sometimes it's complicit with the user acquisition manager who just has to hit his numbers for the quarter. Sometimes they're complicit with the advertiser or with the publisher. But it's a reality. And whether it's Tune, White Ops, Pixelate, IAS, there's tons of studies out there that show this. Half of video views are fraud. 15 or 20% of all ad networks are 100% fraud. Viewability is frankly a joke of a standard. I'm sorry the IAB woman isn't here, but that's just the reality of it. 1 second. Sorry, did you see that? Did you see that? 1 second. It really isn't enough. It's very lowest common denominator stuff. And I think that makes the reality apparent, which is that a lot of ad tech is living off of arbitrage of some sort and willful blindness to the fraud. Transparency, again, how many people really want that? I think Twitter is a great example of that. It's a brand that has tons of bot traffic. Any of you here able to retweet 12,000 times in a second? Kind of difficult if you're really fast. So here was the New York Times study about The mysterious families of accounts for Twitter, how people built from 100,000 to 1 million followers, they bought them, of course. And guess what? Those, when the New York Times story came out, all those followers vanished. Why? Because it just took one keystroke of the delete key to get rid of them. They weren't real traffic, real impressions being sold. They were automated impressions. And how advertisers bought into that, I don't know. This is one of these sort of Humphrey Bogart Casablanca moments where you say, I am shocked to find there is so much attribution fraud in this system. There's gambling in this place, you know, that people should be shocked. Lotame, everybody know Lotame? They purged 400 million, sorry, I think that was a comment about Lotame, or, you know, they purged 400 million bots, profiles. I mean, they had 400 million profiles that were not real people, and they didn't know. That's just an astonishing number. And you know, I know it's different in every country. Here's my favorite example from China. This is Weibo's MAU growth. It is just too perfectly following for this linear pattern. And any of you know, you flip a coin 100 times, you might end up with 50-50, but you're going to get 7 heads in a row or 4 tails in a row, right? This is just too smooth a pattern of a platform that openly admits that they have a large portion of bot traffic, but say they exclude it from their numbers. It's too smooth to believe. And we've seen too many instances of that. The way I see our company's job is to point this stuff out to investors, since, like I said, the investment banks or the industry analysts are there to cheer it. And you know, whether it's click injection, app install, we've heard a lot about cookie bombing, bot traffic. It's like humans, viewability. This is all, it's rampant, and it really is a massive cost savings opportunity for the advertisers and the publishers that don't accept it. The ad tech companies that don't acknowledge this are going to be quickly put out of business. I think it needs some industry-wide acceptance and for behavior change, and it's going to get a heck of a lot harder starting in Europe and spreading elsewhere to blend that first-party and third-party segments to find these fragmented audiences. So what have I said? What did I say? First of all, please don't trust financial market community commentary. It is full of conflicts of interest. It is full of things that are meant to deceive and manipulate and mislead you and bilk you out of your money. Cash burn for companies is not a virtue. And stories really are no substitute for strategy. So I would say adopt towards all this. I know it's very hard in the midst of a rising equity market to sort of stand back from this, but adopt a very skeptical tone. Second, the reality is one of digital empires, and whether I may feel that's unfortunate as a public citizen, you have to deal with it. There is no digital empire that views the word open as anything other than a 4-letter word. None of them want open anything. You know, the aim is to own both sides of the trade, and if you're counting on regulation to save you, it's going to take many, many years, and there's going to be many, many companies lying by the roadside before that has an impact. Third point, GDPR is going to start to clean up the data resale business, these data magpie businesses that go and pluck a little data from here and there, if not all the fraud. But there is no future long-term for relying on arbitrage business models in the same way as the stock market relentlessly collapsed the spread and the amount of money that was left in arbitrage down to very low numbers right now. First P data sets are going to get more and more valuable. This is a super dynamic, unpredictable, exciting time in tech. I really love doing what I do. If you're interested to see the presentation, you can reach out and drop me a mail, and or Ariel will get a PDF of it to send along. Please don't carpet bomb me on LinkedIn. If I haven't met you and had a conversation with you, I'm not going to connect with you because I get carpet bombed constantly with dozens of people from LinkedIn, some of which may or may not be real people. But I'm happy to connect with people that we can share some ideas or what have you. I don't know if we have time for a Q&A or questions or any of that, or we just left everybody in stunned silence and deep depression, and with that, we'll leave it at that. Thank you.